The global debt tied to inflation, worth more than $3.5 trillion, is starting to cost. Britain, with about $770 billion of loans linked to retail prices, is feeling the strain. For decades, governments and corporations worldwide accumulated trillions of dollars in debt, the interest costs of which fluctuate with inflation. What was once an affordable funding source when prices were static has rapidly become more costly. This predicament related to inflation is reflective of broader challenges, surfacing at the end of over a decade of global economic ease, during which debtors borrowed substantial amounts at low, and sometimes negative, interest rates. Investors are cautious about financial vulnerabilities following a crisis in U.S. regional banks this year, coupled with emerging strains in commercial property. As central banks raise key interest rates to tackle price pressures, borrowing costs have significantly increased for governments, businesses, and consumers. Rates on inflation-linked loans have skyrocketed, but they aren't the only source of discomfort. Standard bonds with fixed rates need to be replaced with costlier new debt as they mature. Simultaneously, interest rates on loans are typically variable, meaning they rapidly reflect changes in policy rates. Yields on benchmark 10-year fixed-rate bonds, indicative of government borrowing costs, have risen to around 4.3% for the UK and 3.9% for the US. Both were under 1% during the pandemic. According to Fitch Ratings, governments will pay roughly $2.2 trillion in overall debt interest this year. The U.S. Treasury's interest cost rose 25% to $652 billion in the 9 months through June. Germany's debt servicing bill is expected to skyrocket to €30 billion, about $33.2 billion, this year, up from €4 billion in 2021. Governments had $3.5 trillion in outstanding inflation-linked debt at the end of 2022, accounting for around 11% of their total borrowings, as per the Bank for International Settlements. Britain, which has seen the sharpest rise in debt costs among the group of 7 advanced democracies, is at the forefront of the inflation-linked issue. The UK first adopted such debt under Prime Minister Margaret Thatcher in 1981, becoming one of the first developed economies to issue inflation-linked debt, known as linkers in the UK and Treasury inflation-protected securities, TIPS, in the US. Both the total payable to investors at maturity and the regular interest payments they receive are influenced by inflation. Now, about a quarter of UK debt is tied to inflation, only surpassed by a few emerging markets with a history of skyrocketing prices, such as Uruguay, Brazil, and Chile. The UK's debt problems are further complicated by its long-term reliance on a measure of price increases that is now largely dismissed, the Retail Price Index, RPI. About £600 billion, $770 billion, of bonds are tied to this gauge, which has consistently outpaced widely used consumer price indexes. London has committed to phasing out RPI by 2030. Inflation, as measured by the RPI, hit a high of 14% in October and was still 11% in June compared to the previous year. Economists expect UK inflation to continue declining this year, albeit more slowly than in other major economies. In theory, the surge in interest payouts should be counterbalanced by increasing revenue. Higher inflation should not only mean larger payouts to bondholders but also increased tax revenues. This logic is particularly applicable in markets like the UK, where inflation measures are deeply integrated into the economy. Tax brackets, pension and welfare payments, train fares, and mobile phone bills are often tied to price indexes. However, the recent inflation driven by an energy shock disrupted this calculation, as higher energy bills escalated the RPI, while earnings and consumer spending lagged. The UK is experiencing the wrong type of inflation, stated the UK's Office for Budget Responsibility this month. The agency remarked that the sensitivity of UK debt to inflation was unparalleled. Investors are focusing on the sustainability of the UK's debt following a market crash last fall, instigated by then Prime Minister Liz Truss's plans for tax cuts. Her successor, Rishi Sunak, and his Chancellor Jeremy Hunt, have strived to re-establish market faith, with assurances to curb inflation and reduce debt. As the UK's interest costs increase, and with debt now exceeding 100% of GDP, these promises are becoming more challenging to uphold while keeping investor confidence intact. The debt burden also undermines Sunak's ambition to attract voters and boost the economy with tax cuts and spending initiatives, ahead of a general election expected next year. We could rapidly face a renewed sense of crisis, particularly with an economic backdrop of stagflation with extremely sluggish growth and surging inflation, stated Mark Dowding, the chief investment officer at RBC BlueBay Asset Management in London. Further policy blunders could easily be penalized by the market. Bank of America economist Robert Wood estimates that higher bond yields and more persistent inflation will add an extra £30 billion to the UK's annual government debt bill. The government has three choices: plan for reduced spending, increase taxes, or borrow more, he said. Indeed, this rise in debt interest costs seems incompatible with tax cuts. The UK is issuing fewer linkers, which are expected to account for 11% of bond issuance this fiscal year, down from over 20% during the 2010s. One seasoned UK central banker claimed that linkers largely fulfilled their intended role in the 1980s. We were emerging from a decade of extraordinarily high inflation. There was considerable skepticism about any government's ability, particularly the Conservative government, to reduce inflation to a low and stable rate, said Charles Goodhart, an advisor at the Bank of England between 1969 and 1985. He stated that concerns that linkers would cause new wage price spirals, as unions demanded inflation-linked raises, didn't materialize. Thatcher, who dubbed inflation the destroyer of all, viewed linkers as sleeping policemen, ensuring the government wasn't tempted to inflate debt away by allowing inflation to run. It makes the current fiscal situation more challenging. But that's what Mrs. Thatcher actually desired, Goodhart said. She wanted governments to resist inflation more vigorously. Companies are also feeling the squeeze from inflation-linked borrowing. Thames Water, the UK's largest water company, nearly failed recently as investors questioned its ability to repay £14 billion in debt, about half of which is linked to inflation. Thames Water's debt is tied to the RPI, but customer prices now follow the CPI, which lags the RPI by about 3 percentage points more slowly.